Hello, Vetted VA. This is Hammer. It's about that time. It's Wednesday. We're here with your weekly rate update and market update. And I am joined this week. I'm very proud to be joined by a friend of mine, Eric Tan, who is very much a servant of the veteran community. And Eric, please go ahead, take a minute, introduce yourself, tell everybody where you're from, a little bit about yourself and your experience in the mortgage business.
Awesome. Thank you, Hammer, for having me here. My name is Eric Tan. I am with VA Wholesale Mortgage. I've been in the originating business since 2001. There was a little bit of hiatus for me, about 4 years, but came back into the industry, and I've been in it since then. So total years, I would say about 15 years, a little bit over 15 years. And I'm with VA Wholesale Mortgage. We're a vetted company, company in the sense of being vetted by the Veterans Administration. So we've been recognized as a veteran-owned small business, and most of our companies are veterans as well.
Awesome. Fantastic. Well, thanks for joining us today. So we're going to start off. Let me bring the screen up and we're going to jump in and kind of just remind everybody. So if you're here live, do us a favor, say hello. Let us know that you're here. Give us a hashtag live. I see there are quite a few of you. We do broadcast on YouTube, a couple different Facebook groups. If I don't see your name, please feel free to introduce yourself in your comment and I'll know who you are. But definitely be a part of the conversation. We have a lot to talk about today, a lot of things going on as far as rates in the market and also what's going to happen next week. So we'll be talking about that. So ask any questions you have, share any of your thoughts. If you're watching us on the replay, I know many of you are busy and you can't make the live calls. We do monitor the posts. So go ahead and ask any questions you have or share any thoughts. And also, if you find value, if you like us doing these, you got to let us know, because if nobody watches, we'll stop doing it. So if you like it, give us a hashtag replay. Let us know that you were here. If you're here live, give us a hashtag live. Let us know that you're here live, and we'll go with all that stuff. So that part out of the way, I am going to jump over to my little remarkable. I kind of want to give you guys an update on where we're at, kind of where things went last week and where they're going this week. So last week, actually, rates started the week. They were a little bit worse. So we started out a little blah is what I'm going to call that one. So we were a little blah when we started the week on Tuesday, because we came back from Labor Day weekend, and Tuesday was a bit of a rough start, mainly because the rest of the world kept on going on while, the U.S. was kind of enjoying the lazy, hazy days of summer there. So we started a little blah, but we actually did improve on the week. Really, basically at the end of the week, we just started to see rates kind of improve a little bit. We've seen rates recently touch up into the highs like we saw in June. For VA loans, that would be generally, again, very rough estimate. Your rates are gonna be based on your unique situation, but rates generally, let's call it somewhere in the mid fives. And for conventional loans, if you were not getting a VA loan, you're probably looking at a rate of probably about 6.25% was actually where we were touching. Again, that's a very just an average median kind of starting point to go on there, but just to give you guys something to go on from week to week. And then this week, I had a little bit more faith. Eric, I thought things were going to improve. I don't, I know that you actually kind of listen to me. We once in a while we talk about what's going on with rates, and I said, hey, this should be a pretty good week for rates. And my thinking behind that was that we were heading into inflation data this week that I figured would show that all of the past Fed rate hikes that we've seen in the last few months since March would start to slow inflation down. So I figured, hey, this should be a pretty good week for rates. They're not going to improve tremendously, but we should start to see some improvement. However, we got that consumer inflation data yesterday, and frankly, it was just a kick in the head. The markets weren't really happy with it. We did see inflation get slightly better. It improved. I have to remember off the top of my head here. They wanted it to go from 8.5 in July to 8.1 in August, right? These are the numbers that they came up with, and it came in at 8.3. Now, what's 0.2 among friends? But it was a big deal. So what happened is markets got this data, and even though inflation is very, very slowly improving, and again, these reports depends on how you look at them. We've got, a regular inflation report. Then we have what's called core inflation, which removes energy prices and food prices because they're considered to be volatile. So depending on what you were looking at, some was higher than others. But yesterday, mortgage rates, not so good. Did you find that same thing, Eric? How were mortgage rates yesterday? What did you see happening?
Yes, I was kind of taken back as well as far as the rates. Obviously, we had some clients who wanted to quote that day, and I said, hey, this is not a good day for it. So let's wait until tomorrow, see what it brings for us.
Yeah, and that's great advice, and that's one thing that we try to remind everybody is, in order to help facilitate getting what you feel comfortable being a great rate, we encourage you to shop around. But when you shop around, you got to shop right. And what that means is if you had gotten a quote on Friday and then you got a quote on Tuesday, well, that would have been a real big difference. Just a couple of days could have been a quarter point or maybe even 3/8 of a point, which is 0.375 in interest rate. So you want to make sure when you're shopping, you want to shop at the same time. You want to try to get rate quotes that are within a few minutes of each other if possible, but definitely within a few hours. And you want to make sure that you're comparing all the fees and costs on your loan estimates on that. Right, Eric? Is that generally the best practice you think if you're going to shop around for a rate?
That's basically what we tell our clients, Hammer, is say, hey, if you're going to shop us, do me a favor, shop it during the day that you ask us for the rate. So that way you have an apple to apple comparison versus apple and oranges.
So what I'm going to do is I am going to jump in on this other screen. Bear with me 1 second. I actually took a red eye this morning in from Las Vegas. So I am just getting back into my office right before this call. And so a couple of things I just didn't have that I usually have up on the screens. I want to show everybody when you're looking at mortgage rates. We've talked about this before, but I think it's important to kind of go over it for people that are joining us maybe for the first or second time. When you look at interest rates, and let me go ahead and I'll pull this up on the screen so that you guys can see what I'm talking about here. Oops, there we go. I got the Apple thing going where I can slide everything over. So when you're comparing interest rates, let me just get rid of this and we'll start with a fresh drawing pad here. So when you compare interest rates, there's basically two factors that come into a lender's rate when they decide, what is the rate that you as a consumer, what are you going to see? There's two different things that maybe Eric's rate might be different from my rate, let's say, right? And the first one is pretty universal, and that's going to be what's called the MBS market, and that's mortgage-backed securities. That is Wall Street, and it's basically what keeps money flowing in so that we always have money to be lending out on mortgages. And we've shown the chart on this before and what that looks like. This is the fancy charts that we see, and this is the performance of mortgage-backed securities. And I'm going to go ahead and just turn this into a line chart for a moment so that we get a little bit of an easier to understand breakdown here. So when you look at this line, when these lines go down, that's actually bad for your mortgage rates. It doesn't mean rates have gone down. It means that the bonds have lost value, which actually pushes mortgage rates up. We want to see this line go up. The higher this line goes up, the better that mortgage rates get. So you can see that recently, if I look over the last 5 days, and I just want to make sure I'm looking at the same coupon here. I know it's a confusing topic. Don't worry about coupons today, guys. We'll talk about those another time. But over the last 5 days here, if you look at this chart here, you can see this is going back 5 trading sessions. So in other words, we're taking out the weekend. So we've got today being Wednesday, we've got Tuesday, we've got Monday, we've got Friday, we've got Thursday. In the last few days of trading, the last few days we've seen rates have come out in the morning and they've been a little bit better. And then what happens is through the day, some lenders are repricing worse. And a reprice, if y'all remember, means that a lender has actually changed their pricing in the middle of the day. Unlike gas prices, Eric, did you know that there is a federal regulation that a station can only set a gas price once per day?
I was not aware of that.
Yeah, it's a federal regulation. So when they set prices in the morning, they have to stick with those prices through the entire day. They're not allowed to change them. So what happens, though, in mortgages doesn't work that way. So mortgage rates can go up or down in the middle of the day. And that depends on what's happening on Wall Street. Everybody sees all the headlines for stocks and the Dow, the S&P 500, but it's actually mortgage bonds and these things here that we're watching that affect where your mortgage rates are. And the second thing that affects your mortgage rates is what we call a margin. So that is basically how much profit that the lender, the mortgage broker, or the mortgage lender, if they're lending directly, that's basically how much do they have to make on this loan in order to keep the doors open? How many people do they have to pay? Do they have stockholders, that kind of a thing. So if you add 1 + 2, that's basically where you come up with your interest rate and what you're going to pay. So the margin, that's where shopping around you're basically going to find the biggest difference. Everybody starts out with the same going to the market, but when your margin, that's where you generally see the biggest shopping around options. So, but looking at this, I told you guys that when the line goes down, I'm going to come up with a witty little ditty here. When the line goes down, we start to frown, and that is really what we've seen. Eric, it's been about a month, hasn't it, where we've just seen rates kind of creeping up. It seems like day after day, just a little higher than the day before.
Yes, for sure. We feel the impact on that as well. So it is our bars.
Yeah, for all the bars. Now, I've been saying to everybody though, have faith. We are going to see a bit of a rebound, and what's basically going to help us see a turnaround and see things improve is we need to see the markets, investors, traders. We need to see a fear of recession overtake a fear of inflation. So I've talked about this before. If we see inflation is bad for mortgage rates. It pushes rates up higher. And if we see fear of recession, that helps drive rates lower. So when I talked about this week, yesterday, we got what was called consumer inflation data. And there's a couple different reports that we monitor. This one happens to be called a CPI report, which is Consumer Price Index. And what it showed us, like I said, is that inflation still extremely high in the eights year over year, meaning we generally want to see inflation around 2%. That's what the Fed's mandate is. And we're seeing inflation around 8%. I don't have to tell you guys what that's doing to your paycheck and how far that stretches. However, that consumer inflation data, even though it was slightly better than the month before, it wasn't enough of a improvement to see rates improve. And instead, we saw that the markets reacted to this with an idea that the Fed was going to have to go ahead and raise rates at next week's meeting even higher. So next week, the Fed meets for their September meeting, and then they're going to meet in November and again in December. And when the Fed meets, they're going to set what's called the Fed funds rate. And that's what they use to kind of try to get inflation in check. And we've talked about the intricacies of this before, but today we'll keep it a little higher level. And we'll just say that when the Fed wants to slow the economy down and try to slow inflation down, they're doing it right now by raising that Fed funds rate. And before yesterday, actually, the belief was that we were going to see the Fed raise rates maybe 0.5% or 0.75% next week. And again, to be clear, that doesn't raise mortgage rates on that day. Your mortgage rates are not going to go up 0.5% or 0.75%. So there's no need to panic. What happens is mortgage rates have already anticipated this Fed funds rate movement, and they've already worsened, and they don't worsen directly. Like if we see a 0.75 point rate hike for the Fed, we don't necessarily see a 0.75 point rate hike in mortgage rates. We may see rates go up, 0.5% or 0.25%. It depends on how the markets are viewing this. But anyway, this fancy little graph I've got up here, Eric, we were looking at that the Fed was going to take the Fed funds rate from 2.25, which is where it is now, to about 3%. And that was the expectation in September. And it was up to over 90% of what we call Fed futures, meaning that the markets basically were pricing in that they believed we were going to see a 0.75 point rate hike. After yesterday's inflation data, though, very similar to what we saw happen in June when rates jumped up, we saw that the market started to price in a full 1% rate increase. So what do you think, Eric? If you're a betting man, are you betting that the Fed next week, do you think we're going to see a 0.75 point rate hike? Do you think we're going to see a 1 point rate hike?
Man, I'm having this fear right now, cold sweats right now, just running through because the Fed's going to increase it. I just don't know how much. Obviously, I'm hoping no more than 3/4 if possible. Let's ease it in a little bit more.
Yeah, and generally, if they do 0.75 point, that's probably going to be better for mortgage rates, at least for the near term. And then if they raise a full 1%, this one's a little hard to explain, everybody. So if the market thinks, and again, based on this chart that I'm sharing with y'all, if the market thinks that we're going to see a 1% rate hike, a full 1 point, there's about a 30% belief, 30% probability we're going to see that. And it's being priced in right now. And that's why mortgage rates are higher than they were to end last week. So if the Fed actually follows through on that, it's actually going to help us a little bit when it happens. However, the buildup, the speculation, the expectation of that Fed rate hike hurts us now. And that's why rates today are higher than what we saw on Monday, because on Tuesday, inflation data, that consumer inflation data came out. The expectation was, okay, the Fed's going to have to be very, very aggressive. They've already been doing these 3/4 point rate hikes. We're not seeing inflation affected enough. And the reality about that, everybody, is they're just not giving, the markets aren't giving enough time. It takes time for all of this stuff to kind of trickle through the economy. But we've seen a lot of different reports showing consumer confidence. People are spending money. The labor market is very strong. So even though we've seen 2 quarters of negative GDP growth, which is what factors into what some people would call a technical recession, we're not really feeling a true recession yet. And that's why there's an expectation that the Fed will maybe have to be more aggressive and that this is going to kind of affect everything. So the what everyone needs to think about is, okay, so how, where are rates going to go? And that's generally the question that we hear the most. Where are rates going to go? So let me just write that in here. And Eric, anything you want to add in the meantime?
No, not right now, but we are seeing a little bit of trend of prices in our area as far as our market dropping slowly as far as in comparison month over month. And I'm sure this is because this right here that we're talking about.
Yes, and that's a great point. So, when we having this up on here, we've talked about this before, and I'll go over it again. So when rates go up, what happens is it's almost like a fulcrum. So we start off with a pivot point here, and if rates go down, prices tend to go up, and that's what we saw happen in 2021, and kind of even into the first couple months of 2022 until rates really started to increase. Once it's the opposite though. Once rates go up, if we see rates actually move higher, then prices can, in theory, they're going to start to come down. Now, one thing though that I think is really important for everybody that's buying a house, and people buying a house, they're very nervous right now, Eric, because they don't want to buy at the wrong time and overpay for a house. And what we're seeing, I drew this one almost level, because prices, the actual sales prices, are you seeing sales prices go down? Or are you just seeing them decelerate, meaning they're still going up, but they're going up just a little bit at a time and much slower, or maybe even staying flat?
I just pulled out a rain report from the rain report, and from our area, we're looking at a drop in price. So let's say July, the area median sales price was around 315. Looking at August at 305. So you see a drop in the price. And also, as far as settlement, from 2837, 2,837 to 2,400, 2,413 settlement that's been done within our area, which is the 7 cities that we cover.
Okay, so you're seeing pricing, the median prices coming down just a little bit right now,
just a little bit.
And you would blame that on seeing rates go up, which means there's a little bit less demand.
Agree.
And what market? Tell everybody again, what market are you in?
So I'm in the Hampton Roads area. We're called the 7 cities. So we cover Virginia Beach, Newport News, Norfolk, Hampton, Chesapeake, Suffolk, and yeah, that's pretty much.
Okay. So you're on the East Coast in Virginia, in that area of the 7 cities there. So for everybody, just get on the, and that's the thing, is that there's definitely pockets, right? There's different places where are seeing different reactions. So in your neck of the woods, you're seeing a little bit of a slowdown. Do you think that that's going to continue? That rates that home prices will continue to go down, or do you think if rates drop, home prices will go back up again?
Obviously, the demands here, with the military and all, I think we're going to continue to have a stable market. It just depending on the time frame. I believe I believe the pricing may drop a little bit more, but I don't think it's going to go any further than what it is right now. Yeah. And I'm seeing a lot more concession as well. So instead of dropping the price down, what they're doing is they're offering concessions.
Right. And actually, I don't know if you were watching last week when I was on with Leroy. We went into a lot of detail about price concessions, a seller concession, why we're seeing more of them. So I won't go too deep this week on that one. You guys can watch the replay of last week's if you want to get a little bit more info on that. But so basically, the idea is, where are rates going to go? And through September, we've only got a couple of weeks left. Next week is a week from today, actually, is when the Fed is going to come out with their Fed meeting. And what's going to happen is they're going to set up what's called a policy rate. So the Fed meeting will take place. They're going to set a policy rate. And then Fed Chair Jerome Powell, he's going to have a press conference. And what tends to happen is a week from today, and we'll talk about this on next Wednesday, we're likely to see that rates will improve a little bit. They'll be choppy in the afternoon through the press conference, and then they tend to improve that day and usually even the next day. That is the pattern that we tend to see in this current environment, because when the Fed does take that action, it's already been expected, it's already been priced into the markets, and it confirms what the markets already believe, and then it's supposed to help fight inflation. And like I have here, we've got inflation is going to push mortgage rates higher. Fear of recession pushes mortgage rates lower. As the Fed is raising interest rates and as the economy is being forced to slow down, there's talk that that's going to drive us into a recession. And there's questions of, will we get what we call a soft landing? A soft landing is the idea that the market will slow down, but it won't go into a recession, and that things will find a natural balance. And this is, I don't know, this is kind of like trying to throw a marshmallow through a a basketball hoop from 30 feet away. It's a tough thing to get that soft landing. So that's kind of the expectation of where things are at now. So when the Fed meets next week, we're likely to see them raise rates depending on how they we'll definitely see them raise rates depending on how much they raise rates. We will see either a positive reaction that helps mortgage rates, or we'll see kind of a little bit more of a negative reaction. In the last few meetings, it's been a positive reaction. So if you are looking at buying a home, or if you're thinking of refinancing and you say, oh man, just a couple of weeks ago, rates were lower. Now I'm seeing rates that could be a quarter point or a half a point or even more higher. Are they going to come back down? Through September, it's likely we will see rates come back down from the highs. We're probably kind of capping out right now. In October, what do you think might happen in October, Eric? Do you think that we have a shot of seeing rates move even lower in October? Do you think things will kind of settle in? Any idea from you?
I'm just looking for some stability here, instead of this market going up and down, just for my buyers. What's your take on the number?
It's frustrating when you see rates move up and move down. Well, one thing we definitely, it's important for everybody to know, we don't have a crystal ball, so I can't tell you what's going to happen, but I'll tell you why I think things will happen. So I think that rates will continue to kind of work their way down and get a little bit better. I think, like I said, conventional rates right now in the low sixes, veteran rates in the mid fives, sometimes 5 3/4. I think those will work their way back down. I don't know that we'll see the fours necessarily in October, but it depends on the idea of, are we afraid of inflation still? And we'll get some inflation data in October. These reports come out monthly. And that report that we got yesterday, when it comes out in October, if it starts to show, hey, we've seen even more of a drop in inflation, this is working, that would actually help mortgage rates to improve. I don't think we'll see rates get much higher. They could get another, let's call it 0.25% if I were to be a betting man. And but just for the record, I just came back from Vegas and I didn't really go there and win any money. I'm still have to work. So if I was a betting man, I'm betting on rates more than I'm betting on blackjack. And then on 2023, to end 2022 actually is what I have here. I think that we will see rates stay within the range we see now, maybe improve a little bit. And then as 2023 takes hold, I think we are going to see a full-blown recession. And as the economy slows down, rates will drop. And that's kind of leads us to that next thing to talk about, Eric, which is, let's say somebody does buy a house right now and rates are higher. Do they have any option in, say, maybe 210 days to get a better interest rate?
There's always an opportunity, just like you said. We don't have a crystal ball here, but that's what we're hoping for, right? My thing to my client is, I tell them, hey, you know what? Marry the house, date the rate, because the rate will fluctuate, but the house pricing will always continue to go up, historically.
Yeah. Especially even if we did see things, say for the next 6 months, if a home price did go down slightly, we're going to see those go back up again over the next year, 2 years, 3 years. There's just not enough housing, guys. We've talked about this with many of our guests, where it's too much demand, not enough supply. There's not enough houses being built. People are staying in their homes longer. We have less multifamily home situations where people are, a lot of different generations in one home. So everybody's spread out. There's just not enough houses. So that's why we're not likely to see house prices drop. This is not 2008. There is no housing bubble. And everybody doesn't have to worry about that. So yeah, that's kind of the same thing. I agree with what you said. We don't have that crystal ball, but if they do want to refinance and you have a veteran loan, you have a VA mortgage, there's an awesome program called the EARL, which is the interest rate rapid refinance loan. And you need to have your loan for 210 days. I think it's 7 payments. Is it? I think is, and then you're able to go ahead and as long as you're saving enough money, you can refinance and you can, it's a very streamlined process. So keep that in mind, that if you do have a VA mortgage, that you do have the opportunity, if rates do go down, you're going to be able to take advantage of that. And people buying today, it kind of puts you in that sweet spot, because rates aren't probably going to go down enough to necessarily refinance over the next 3 or 4 months, but 6, 7, 8 months from now is probably when we'll see rates take a more significant drop. And then anybody buying today, like you said, buy the house, date the rate, they can go ahead and refinance. And it's not an expensive refinance when you do an EARL. There's streamlined costs to it, and it is an easy process. So,
yep.
So what do you think, Eric, as far as the rest of Virginia in your area? Do you find that has inventory improved, or are there still multiple offer situations? You said median home prices have come down a little bit.
Correct. So in our market, like I said, it all depends on, I talked to a couple of my realtor partners, and we had discussed as far as how long is the house are staying in the market, or the homes are staying in the market. It just depends on, location, right? There are some properties out there that are still getting multiple offers, and there are some properties that's even staying in the market even longer. So it just depends in those pockets, areas that we're looking at. And so we're just fortunate that this is a military installation. We have the biggest naval base here. So therefore, the military, they either rent or buy, right? So, and they know that rent here is very, very expensive now. So they opted to use their BAH towards housing. And that's what I think keeps us in the even kill as far as in comparison to the other markets out there in the United States.
Awesome. Very good. So anything else that you wanted to talk about, or anything you wanted to add to today?
No, I think I'm good. Thank you for the lessons here. I really appreciate it. I learned a lot from this session here.
Well, thank you. Then I appreciate you joining me. Remember, everybody, if you are here live and you have any questions, go ahead and post them. If you're watching the replay, do me a favor and just put a hashtag replay. Let us know that you want us to keep doing these for you every week. If you have any questions, we do monitor the post and we will answer those questions. We do these, like I said, each and every week. So 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, or 9 a.m. Pacific. You can join us if you have questions about, what's going on with the rates and the markets. If you want to have an idea of where we think things are headed, that's what we share with you each week. So, well, thank you, Eric. Appreciate having you here. And everybody else, thanks for joining us. And I'll see everybody later. And Eric, you're free to say goodbye as well.
Thank you so much, Hammer, for having me here. Appreciate you.
Take care, everybody. Bye-bye.
All right, bye-bye.